The discounted cash flow method is a method that looks to calculate the value of a company by looking at the cash flows that accrue either to the company as a whole and to its equity and bondholders, or the cash flows that would accrue to the equity holders in absence of the bondholders. What the method looks to do is it looks to calculate cash flows over the life of the company, i.e. into the future, and then to discount those back to today and see what the value of those cash flows would be to the company. And then once we have the value of all those cash flows to the company, we can calculate. That gives an answer to what the value of the company might be based on that calculation. And then by taking away the value of the debt, we can figure out the value of the equity. So the discounted cash flow method has a number of advantages over some of the ratio-based methods, in that it doesn't take into account only 1 year of earnings or 1 year of sales or even just a book value. It actually looks at cash flows from here into perpetuity for that company, and then tries to seek a value based on all of those future cash flows. So intuitively, it's a very attractive method of valuing companies because it looks at the company into the future, and it aims to take into account the company's development far into the future and what the cash flows to the company will be. The big disadvantages, of course, and the big difficulty is that we never know with certainty what the cash flows of the company will be. We don't know how the markets for the company's products will develop with certainty. We don't know the decisions that the company will take. We don't know whether the company will pursue intelligent strategies or poor strategies. We don't know if the company will enter into a merger, try to buy another company, or itself be bought. And we don't know with certainty whether the company's products, whether a better competitor will emerge, or whether there will just be a major product shift away from that company's products. So although the discounted cash flow method intuitively has a lot of advantages in that it takes into account so much more of the future than some of the ratio-based methods do, it comes nonetheless with a lot of uncertainty in that those cash flows that we're trying to project are very, very difficult to assess with any degree of certainty, given all of the things that can happen in the economy with respect to the company's products, the company's industry, better products, foreign competition, consumer preference, and so forth. And again, that is perhaps one of the reasons why valuing companies is such a difficult exercise. Thousands of people in the financial services industry aim to do it, and as well, there are there's a very large number of proponents of market efficiency theory, which again states that conducting valuation analysis in developed markets is very difficult and ultimately doesn't lead to any results that will allow a market participant to exceed the return of the market itself or of the benchmark.